Yes, Coca Cola, it is down around 7% year to date, but is it undervalued and is it a buy? What's the intrinsic value? We'll run through that and our acceptable buy price, and we'll also take a look at some of the important dividend metrics and dividend safety metrics around this company. Now, it is at the midpoint of the 52-week range. It does offer a yield of over 3%, and investors who have been holding the Coca Cola company over the last 10 years would be up around 50%. Now, it doesn't include those dividends reinvested, but personally, I do see that as a mediocre return over the last 10 years. So let's find out whether there's room for improvement over the next 5 to 10 years. So top line revenue, what we typically like to see, 3 to 7% growth year on year. December 2018, 34.3 billion. December 22, 43 billion. So actually nice growth over the last 5 years, and it's positive to see the trailing 12 months are showing signs of around another increase to 45 billion or so. And what we can see though, when we do look on a more granular level, we do see an increase to 37 billion in 2019 before that COVID year, where we do see drop down. But then you could argue, with a lot of essential places shut, Coca-Cola do own the Costa brand. This did affect their essential revenues for that year. It then did pick up in 2021 and 2022, with 23 looking positive as well. So the top line is growing. We'll analyze the last 10 years percentage-wise too to see how that has performed. Bottom line, what story do we see here? Well, 6.4 billion in 2018, 9.5 billion in 22, with the trailing 12 months again showing a nice increase to 10.8 billion. On a more granular level, we do see an increase to 2019 before that expected COVID drop, but then it does pick up and then it does fall slightly before picking up. So there is growth on their financial statement, income statement, top line and bottom line, but we also do see some inconsistencies year on year. Now, a quick health check, total cash versus total debt. What we can see in 2018, their total cash and short-term investments was around 16 billion. Latest quarterly report around 15.4. So they do hold quite a nice amount of cash over the last 5 years. Yes, it has decreased, but we can still see it is quite a strong, healthy figure. Now, numerically and directionally, when we compare that to total debt, we see it has gone from 44 billion to around 42. So we can see their cash has dropped slightly, but so has their total debt. So they are starting to pay off some of that debt. Now, in terms of how the company has performed over the last 5 years versus some well-known competitors, we have PepsiCo, Monster Beverage, Dr. Pepper, as well as a few others. Year to date, now Coca-Cola, remember dividends included, reinvested, is one of the worst performing, down 3.74%, pretty much in line with Pepsi. When we extend that to the last 5 years, what we see in actual fact is it is up 40%, but it is also one of the worst performing, in fact worse performing than PepsiCo. So hasn't had the greatest last 5 years either, but it is something to bear in mind that past performance is never indicative of the future. Now, institutional ownership, it does sit at 69%. 10 billion worth of these shares have been sold over the last 12 months, although institutions have bought significantly more over the same period. But do note that the latest quarter, Q3, we do in fact see more selling than buying by these institutions. With the preceding 3 quarters, a lot of buying. We do see a huge buy in Q4 of 2022 for Coca-Cola. Now, something just to bear in mind though, we don't copy what the institutions do, and it is just part of our analysis, and always do your own due diligence. Now, in terms of the dividend safety, before we jump onto that, we can take a quick look at Coca-Cola's earnings. And it is positive to note their previous 4 quarters, they have had a double beat on the earnings per share and revenue, as we can see here. Q2 double beat, Q1 double beat, and Q4 of 2022 another double beat. And when we analyze their Q3 September versus Q3 22, we in actual fact see their top line that has increased, bottom line has increased, earnings per share as well as a few other metrics also increasing. So they're also not just beating analyst estimates, but also increasing on the previous year. So lots of positives to note, but remember it is also important to understand the financial metrics behind the company as well as the valuation. Now, dividend safety score 80, it is safe. 254 billion, it is a mega cap company. Now, some key recessionary metrics for those that see a recession around the corner. They increased the dividend during the 07-09 recession. Negative 5% sales, but that is still above the average growth of companies in the S&P. And we do see here they also outperformed the S&P with a negative 31% return versus the S&P 500's negative 55%. Now, they had a 4.5% increase in terms of that dividend in February this year. I would say it's mediocre. It is at least in line with inflation that I always advocate at 4% as a minimum. Last 5 years, again, so you are essentially every year just keeping up with inflation. Last 20 years, however, we see 8%, which is positive to see. Now, in terms of dividend growth, well, they have been paying increasing dividends for the last 60 years, so they are a dividend king. Remember, dividend kings are those companies that increase their dividends year on year for 50 years or more. But also another phenomenal metric, they have been paying dividends for the last 103 years without a reduction. Now, dividend yield theory states that the company is undervalued when the current yield sits above the 5-year average. 3.13 versus 3.06, you could argue reasonable valuation / slight undervaluation. Forward PE 21 versus 24, this is a sign of undervaluation. And we can see the sector PE slightly lower at 18.5. Remember though, undervaluation or not, we will analyse all of this towards the end in our conclusion. Free cash flow payout now below 60% is my personal preference. Consumer staples, you can extend this to 70%. What we see over the large part is that Coca Cola is essentially a mature company. They do pay out a lot of their free cash flow in dividends, as we can see, pretty much 80% over the last 4 years. 2023 expected to be fairly similar at 77%. Something just to bear in mind as an investor and a dividend investor at that. Now, free cash flow growth, 180 in 2013, 220 in 2022. Now, look, this isn't a company that has fast-growing free cash flow year on year. We also see the inconsistencies where it dips. Yes, it is expected to be slightly higher in 2023, but just understand the type of company you're investing in. Some are fast-growing, some are essentially very stable. They pay their dividends on time, increasing at a certain percentage every year. Just make sure you do understand whether it's Coca-Cola or another company, the type of company it is. Now, Coca-Cola, the growth, are ridiculous from 2013 to 2018. That is some horrific growth, well below the minimum inflation that we look for. And only the last 2 years have we really seen some nice double-digit growth, with 2023 expected to be 6%. So numerically, what does that even mean? Well, what it shows is that, one, they are not even keeping up with inflation year on year, but that in 2022, 43 billion was their sales, which was lower than 10 years ago. And on top of that, if you adjust for inflation for their 2013, you'd probably be looking at significantly higher in the 50s. So in real terms, their revenue top line is decreasing. Now, shares outstanding, yes, they do share buybacks, returning excess cash to investors. 4.51 billion in 2013, 4.35 in 2022, although some people would argue they would like to see this at a quicker rate. But one thing to note, from 2013 to 2018, they did do share buybacks. 2018 onwards, they have done some share issuances year on year to dilute your position. But over the whole period, we do see that their share count has decreased. ROIC, very nice to see, well above that 10% minimum that I look for, giving me faith in management and their ability to effectively allocate their capital. 2023 expect to be the highest at 18%, so it is a positive sign of management. Operating margin, very nice, consistently above the 16% and in fact increasing over the last 10 years. And the same could be said for the free cash flow margin, very nice to see the last few years in the mid-20s. Net debt to EBITDA affecting that dividend safety and the essential safety and strength of the balance sheet. The maximum number we look for consumer staples is 4. This signals the number of years it would take the company to pay off all of their debt net of cash on hand. 2022, 2.19, nice to see it's come down from that over 3 in 2020. 2023 expected to be even lower. So that safety in the dividend is very high for Coca-Cola Company, as well as the fact that they do have a fairly strong balance sheet. Now, in terms of the valuation, and as always, if you're enjoying the content, values being provided, smash the like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, then do go ahead and click on that pinned comment below. Now, for Coca-Cola, as always, we don't tend to use Graham's valuation. It isn't really applicable for very long, mature companies such as Coca-Cola or companies that have extreme growth on the top line, so therefore this won't be used. So the first model we are using is the multiples valuation model. Companies in a similar sector and size, their average PE multiplied by the earnings per share of Coke to get a stock price of $73. Now, when we take a look at that, we can see that is well above the current trading price and in fact above the 52-week high. So that is some signs of undervaluation based on this model. But again, as always, We do look at all of these in our conclusion towards the end and never in isolation. We then move on to the DDM model, the dividend discount with the yearly dividends. Now, for me, this is fairly mediocre, but you do know what you're getting with the Coca Cola company. On average, 3.4% growth. Now, I've gone for 4.75 forward looking. You could argue this is too optimistic or even too pessimistic. So when you grab a copy of the model, you can play around with these numbers to get your own values. Based on my estimate, this gives a DDM price of $59. Now, this is essentially right at the current trading price. So on the DDM model, it shows that the Coca Cola company is fairly valued. Now, moving on to the discounted cash flow, where we have the free cash flows year on year. Average growth at 4%, forward-looking. Analysts estimating around 10 to 11%, so we have gone more conservative. With our discount rate, we get the present value of future free cash flows. Add together the cash, subtract total debt, get to equity value, divide by shares outstanding to get a DCF price of $61. As we can see, slight undervaluation / reasonable valuation, up to around 5% on the upside, but still below that 52-week high. Now, the intrinsic value, as always, is just the average of these models. And for today's episode of the Coca Cola company with these updated figures, we got an intrinsic value of $64. Now, current price sitting around $58.74. As always, 10% margin of safety is what we start off with if we believe it has a wide moat, strong financial metrics, good forward-looking data. Pretty much is right there, I would say, $1 shy of the current trading price. So you could argue right now that with the Coca Cola company, you are getting approximately a 10% margin of safety. Now, for me, this isn't a company that I will invest in. Just the dividend growth is very, very shockingly low. It isn't one that at times keeps up with inflation. But having said that, this is one that I would pick up if we do see it come to a very, very low price based on the margin of safety, a minimum 20 to 25% margin of safety. So it isn't one that I will really be adding unless this comes below $50. So for me, this isn't one I would be adding. But Wall Street, they do believe there to be some nice upside to the current trading price, pretty much in line with our intrinsic value. So right now for Coca-Cola, we believe based on the estimates and judgments we've gone through that you are getting around a 10% margin of safety, and Wall Street do see more than around 10% upside to the current trading price. As always though, let me know your thoughts in the comments below whether or not Coca-Cola company is one you're adding or you added when it did drop a few months ago, and let me know if you also believe this isn't the greatest dividend growth investing paying company. As always, smash the like button if you've enjoyed the episode, hit the subscribe and bell button so you are continually notified of these videos as they drop, and click on the pinned comment below so you can grab a copy of the intrinsic value and get to the acceptable buy price of companies in your own portfolio or on your watch list. As always, have a great day and catch you on the next episode.